Hello everybody, this is Toni Turner and welcome to the market now on Thursday about 1:30 p.m. We're doing the market now today because as for Good Friday. U.S. stock indexes are lower today ahead of the long Easter weekend, dragged down by financial stocks, while gains in the dollar hurt commodities. The dollar was on track for its best streak in almost a year as recent comments by U.S. Federal Reserve for more than one increase in interest rates this year, with the first perhaps as early as April. Oil prices this morning fell below $40 a barrel as U.S. crude inventories touched record highs. Data also today showed durable goods orders fell less than estimated in February, while better than expected jobless claims data showed the labor market was stronger than previously thought. Now let's look at three charts that could give us some insight into the week to come. The first chart we're going to look at, as we usually do, is a chart of the S&P 500 Spider, the SPY. This is our tracking stock for our U.S. S&P 500 index. Okay, so we look at this chart to 41 cents, which is about 2024 on the S&P 500 itself. It is trading just above the 200-day moving average, which is the black line on this chart. These are all simple. 202 at 202.30 and on down to, of course, 200, which would be 2,000 on the S&P 500. And of course down to 201.50 right here, which is kind of a pretty, hopefully, strong support area for the SPY. And then of course we can move down to 198 and so forth, down further, down toward the green line, the 50-day moving average. But there is quite a bit of potential support here should the S&P 500 decide it needs to move lower. Now we know that from the February lows at about 181, the S&P has made pretty much a straight up move here, coming up to these highs just a little over 205 and doing this whole big jump here in pretty much a straight move up. We know there was a lot of short covering in it. You can always recognize short covering when price comes off the bottom and does a bunch of easy way to see short covering in here, and that's okay. And the buying continued again up to 205, so we've made about a 13% recovery here without slowing down for very many breaths. Now it seems to me that the SPY may need to take a breath here, and I suspect it could come back down toward 198. Of course, that's just a guess. That is not certainly anything that I would know for sure. Neither would anybody else who I know of. Now, the SPY came up to its overbought level on the 14-day RSI, came up to just under 70, so it did attain overbought status. Now the RSI, of course, is moving down with the SPY. We also see here where we have the MACD plotted over volume spikes. We notice that the black line, which is the MACD line, is coming together with the red line, which is the signal line, and the MACD line itself looks poised to cross down below the red signal line. And of course that's a mild negative. That's just saying that the SPY is losing a little of its giddy up here. As well, I think it should. I think a pullback here in the next week, in the upcoming week, would probably be healthy. We need to get a little bit of the air out of this before we move forward here and actually move out of the third quarter, which the third quarter comes to an end. Next Friday is the first day of April, and that next Thursday will be the end of the quarter, I should say of the first quarter is what I meant to say. So what I would say here is that we should be careful entering new long trades here. The market's a little tired. I suspect, again, we could have a pullback into the coming week. So if you're entering new long positions, depending of course on their charts and the sector they're in, you may want to keep those share sizes rather maybe conservative going into next week. Our next chart here is the iShare Russell's 2000 ETF. This is the IWM is the symbol. Now we use the iShares Russell 2000 ETF, or the index itself, as kind of a leading indicator for the broader markets. We know that small caps that make up the Russell 2000 are mostly U.S.-centric. Most of them don't have international trade. Companies don't have international trade. So they're kind of, this is what the U.S. stocks are doing. That's kind of how we can look at this. And many times the Russell 2000 will act as a leading indicator for the broader market. We can see here that the IWM fell from the last week in December up here. It was trading just under the 50-day moving average at about 115. It fell down pretty dramatically here, down from 115 in the last week of December, down here to the February 11th low of $93.64. That's about an 18% drawdown. So now it did manage to rally, and like small caps usually do, when they do something, they're the drama queen. They go overboard. So when it did rally, it rallied right back up past this resistance at about 102 or so, rallied right back up, moved back up, and came up recently to about 110. In the last few days, it sold off a little bit. Now today I captured it at $106.63. It's sitting right on consolidation lows here. So it has price support at 105.50 to 105. As I captured it again, it was at $106.63. So it's just below the 20-day moving average, still above the 50-day. And again, sitting right on support lows here of this current consolidation. What we can see here that's kind of interesting, note here with me that the IWM over the last couple of weeks has made a higher high coming up to this 110 zone from its prior high. However, at the same time, the 14-day RSI has said, you know what, I think this is a lower high. I'm not at all impressed with the IWM's second high that it made, and I'm calling it a lower high. That's the pattern I'm making. So when we see a bearish divergence, meaning the indicator is bearish and the divergence part meaning that the price is bullish, so there's obviously a divergence there, we many times tend to keep this bearish divergence in our back pocket, or maybe we keep it on a sticky note in our monitor, because the RSI is saying here again, that last price move did not impress me very much. So something to keep in your back pocket, no reason to sell everything, but something to keep in your pocket just to stay wise. We can also note that the MACD here, the black line, I don't know if you can see it on this chart, but I can, and it is slightly moving below the red signal line, so that's a slight negative as well. If the IWM in the coming week happens to definitely start down toward 103, where the 50-day moving average is pretty much moving horizontally. The other thing is that if the IWM drops below 105.50, 105 and heads lower, it may well have the ability to pressure our broader markets lower. So kind of use that as as a leading HF. What I notice is that it's got beaten up, and certainly healthcare has gotten beaten up recently, but it hasn't gotten beaten up quite as badly as some of the others, and it's managed to get steady here. And right now, when I see something that looks, it's just something to keep an eye on here. I'm not saying I'm going to buy right here. I'm going to let the market roll into the first of next week and see what happens. We have jobs numbers next week. But I am going to keep an eye on the IHF. As I captured this chart, it was 23 cents. This is the U.S. healthcare providers, and the top components are United Health, Express Scripts, Aetna, Anthem, Cigna. You know that group, neutral territory. The MACD is just trading sideways above its zero line. So obviously the IHF here could break out and go higher or lower. It fell to $5.56. And if we look left on the chart here, we can see that last June, look up at the top of the chart, last June it was trading as high as $146. So it's had quite a big move down since last June for sure. But it's been fairly orderly. Now it looks like it's consolidating here if we're back to where we are today. It's consolidating now. If the market heads lower in the coming week, I suspect that the IHF will head lower as well. It could head back down to its 50-day moving average. As well, it could, if the market heads higher, it could break out. I'm watching the IHF to see if it comes down, if it stays above the 50-day moving average. And please note that if it falls below it, I am no longer interested in the IHF, at least at that time. And that's what the red highlighter is for. It's like, oh, if it falls down there, I'm no longer interested. But if it manages to stay above it, even in a market pull down, and then can move back up to 120, we break out over 122, break out over this consolidation, then I will be interested in possibly adding some shares of that. This is not a day trading product. It doesn't have enough volume in it to day trade it, but if you want to get in something and hold it for a little bit longer, possibly for the duration of an uptrend, you may want to look at the IHF if it can break out over 122 and start higher. Okay, now we'll go on to next week's economic reports. But first, please check out our brand new hot off the presses online training program, Trade Like a Master, Supercharge Your Brain for Maximum Profits. Diane Alexander, who is a psychologist and neuroscientist, and I have developed this program to show you how to power up your brain and earn more money trading and investing. This is a revolutionary new concept that can help you make breakthroughs in your financial future. Trade Like a Master is being offered now for an extremely low price, an introductory price, but this price will be raised very, very soon. Don't miss out. Check out the link on this screen for more information. That's tonyturner.com/supercharge. And now for the coming week's economic reports. On Monday, we have PCE core prices and pending home sales. Tuesday, we have the Case-Shiller Real Estate Index and consumer confidence. Wednesday, we have the ADP employment change, crude inventories. Thursday, we have the weekly jobless claims and the Chicago PMI, which is a purchasing manager's index. And on Friday, we have a lot going on, a lot of reports, because it is April 1st. We have the monthly jobs numbers with the unemployment numbers. We have the ISM index. We have the Michigan sentiment and the auto and truck sales. Again, be sure to check out Trade Like a Master. You will be very glad you did. Until next week, happy Easter. I'm Toni Turner, and this is The Market Now.